Hello, I'm Paul Donahue with Mutual of Omaha Mortgage with a very special event here today. I have joining me my colleague Don Graves talking today about liquidity and a home equity solution for a very interesting case that we think is compelling. And so, with that, I'd like to introduce my good friend and colleague Don Graves. Don, hello. Thanks for joining us today.
Hey, Paul, thank you for having me here today, folks. Oh, this is going to be great. I love the Circle of Wealth family. Had opportunity to spend 3 nights at Don Buddy's house, had some steak, played some golf, and we had a great time. But we want to get to this case study and why we think it's important to the Circle of Wealth leadership. So I'm going to share my screen here. And so, just by way of an introduction, I'm Don Graves. I serve as the National Business Development Manager for Mutual of Omaha Reverse Mortgages. But I'm also an adjunct instructor of retirement income at the American College. I'm in my 26th year of doing reverse mortgages, and in that time, I've had about 16,000 consumer facing conversations, and around 3,000 people went forward to become my clients. That tells you two very important things. One, I've talked to a lot of people, and two, I know this is not always a great fit for everyone. I've coached now some 30,000 advisors over this time, and I'm the author of 3 books. One of them was a bestseller for at least 30 hours. But what's important today is that retirement is going to be different. Retirement is going to last longer, be more expensive, and way less predictable. And today's advisors are being asked to know more, do more, solve bigger concerns, but provide different options. And that's what we're here to talk about today. Housing wealth as a different option and alternative when you know how to use it becomes very important. The U.S. Census Bureau says it's the largest single concentration of wealth in the average baby boomer's arsenal. So, how do we use it? How do we take our Circle of Wealth software, combine it with the things that Paul you've developed with Circle of Wealth called Equity Works Pro? And we're going to look today at Joe and Connie. They're 72 and 70. They've got some children and grandchildren. Joe's mom and dad moved in with them. Connie retired his wife to help care because dad has the advanced stages of dementia and mom has limited mobility. Their financial snapshot is they've got a home, more than $1 million, no loan balances, total retirement savings, $865,000, and that's spread out with investments, annuities, some life insurance, some IRAs. Then their primary retirement concerns, like most folks, I don't want to run out of my savings. I don't want to reduce my lifestyle, but the thing that really is top of mind for them right now is we need money for extended care planning because we don't want to become a burden to our family. Remember, their family, mom and dad just moved in with them, Joe's mom and dad. So that's important. So, how do we use housing wealth with our Circle of Wealth software to begin to provide some different options? Well, a reverse mortgage, the amount of money you get is based off of 3 things: the age of the youngest borrower, the home value, and the future projected interest rate called the expected rate. And so around $376,000 is made available. Now, here's what's important: this is called a growing line of credit, a growing line of credit. So, what does that look like? That means a reverse mortgage line of credit. It started out over here at 376. But at 85, it's this much. At 90,000 projection. But look at age 100. That's $4.2 million. I think one of the most fascinating things to most folks is that a reverse mortgage line of credit is a growing line of credit. And Paul, with that and this backdrop, can you tell us how Equity Works Pro combines with the Circle of Wealth software to make sure and to give the advisors some different options?
Joe and Connie Wilshire came to me from one of my Circle of Wealth advisor partners, and they realized they had a gap in their strategy, which was they had no long-term care strategy in place. And they started looking at long-term care insurance, and they looked at their housing wealth and going, you should go talk to Paul and take a look at the liquidity that we can create, the account that we can create by converting a portion of the home equity into a growing line of credit, which is what Don was talking about. And I want to illustrate that. And just to set this up, you can see what Don was talking about, the $865,000. The advisor said 5% is a realistic idea of growth over time. You can see the house, the home value at 1.25 million. That's what it appraised for. And there's no mortgage on the home. All right. There's no mortgage on the home. And their priority, when they came to me, their priority shifted from leaving the home as a legacy to the children to we do not want to be a burden on our children. And so they started looking at the home equity and the wealth in the walls a little bit differently as a possibility of a tool. So we want to lay down a principle here because we know liquidity in retirement is a key concept for success. And so rule number one is that you shore up your lines of credit when you don't need them so they are in place when you eventually will. And that's what this strategy was all about, is the earlier that you can put the line of credit in place, the better. So let's take a look at what that $376,000 line of credit that Don was talking about can grow to. So when you take a look at the line of credit and the savings, and you add those together, you get this liquidity number, and liquidity is key. And all the while, we're creating an additional bucket of cash that can be drawn out as they need it tax-free. It can also serve as a buffer account for sequence risk. It can deal with emergencies. It can do a whole host of things when you add an additional cash asset like housing wealth. All right, so let's take a look at time. When he came in and sat down with me, he said, I don't need any cash out. I just want to know, what will this line of credit grow to when I'm 85? And then he wanted to look at it at 90. So we go out there and we can take a look at 15 years. You see the line of credit growing, watch that liquidity number, and at 85, that line of credit will grow potentially, depending on what interest rates do, right? You can see the line of credit grew to 1.2. The savings have been protected because they have this buffer asset. If they needed to draw money out, you've now got another asset class you can draw from. But look at the liquidity number. It's fabulous. And then he goes, he leans over to Connie, he goes, there's our long-term care strategy right there. And then he goes, what does it look like at age 90? At age 87, 88, 89, 90. There it is. At age 90, that's 1.8 million. All right. Then he goes, all right, let's say I have a long-term care need at age 85, and I need $15,000 a month for 4 years. What would that look like? And I said, yeah, we can show you that. He goes, will the line of credit hold up? Will that provide enough cash? I'm going to put in $15,000 a month. They're going to draw out starting in year 15, and going for 4 years. So that would be 228, the 228th month. So that's 4 years of $15,000 a month. Let's take a look at it now. Watch what happens at age 85 when we start drawing that money out. All right. Will it hold up? There we go. Age 85, that's $180,000 a year that we're pulling out tax-free from the line of credit to serve as an in-home care strategy, perhaps some dementia care, or maybe he needs to go into a facility and get full-time care. Now we have a private pay strategy, right? That protects the home and that they can pay for it. Does the home survive? Does the line of credit survive? Yes, it does. So after 4 years of $180,000 a year, we're still at almost somewhere between 850 and 900,000 and available that can go to the surviving spouse. One of the beautiful things about the home equity conversion mortgage, the HECM line of credit, is that it secures the home forever for both spouses. So if something were to happen to him, she can stay in that home and she still has plenty of cash to tap into. And take a look at the savings tank. Because they had this liquidity that they could draw on from the home, it protected the savings asset. So look at 90. Now, what if at 92, 93, she needed some care, there's still a million one in the line of credit that can be drawn out for her care. And if she stays in the home, passes away while she's in the home, now the kids still have plenty of equity. Take a look at the equity. So at the equity of 1.5 to 1.7 is going to go to the heirs. All right. The heirs get the remaining equity in the home, plus they're going to get all the savings that's going to pass along to the family. So there's plenty of legacy to pass along. What we did is we created a critical solution that gave you, the advisor, another option to solve problems, to adapt to changing circumstances in the retirement, in the years of retirement, and as they get into their elder years. So I'm going to stop right there, Don. I just wanted to share that growing line of credit and how flexible it is, and how it can not only serve as an asset bucket, it can also protect the other assets as well, and the heirs get all of the remaining equity. So there's going to be plenty of legacy to pass along, and that was a key concern for them. But most importantly, they didn't want to be a burden on the family. They saw this as a solution, and we ended up doing this loan for them. And of course, they're both extremely excited about the move that they made to do that. So with that, Don, what's your thoughts? I'm going to stop my share
Mhm.
and just get your thoughts on what we just saw here.
I think this is a wonderful example to the Circle of Wealth family that advisors have to know more, do more, solve bigger concerns, and provide different options. What a valuable tool that this Equity Works Pro, combined with their Circle of Wealth software and how it integrates, that it's going to give significantly new and different types of conversations. One of the things I teach in the course on reverse mortgages is there are 52 different retirement income planning strategies. That's just one, Paul. Imagine the Circle of Wealth advisor not only having the software, but having the practitioners, you and I, as their personal coaches, walking them through scenarios and helping them to expand that dialogue. Today's reverse mortgage is a powerful tool, very different from 1961 or 1988 when the federal government began to oversee it. It's a different animal. And I'm grateful for the work you've done, Paul, with Equity Works Pro, along with the Circle of Wealth family. I think, not I think, I know this partnership, this tool is going to be significant, us working together with them. So thank you for putting that together and sharing. Any last words for the Circle of Wealth family?
Don, thank you for your passion and your expertise and your partnership. We work together all across the country, and so we can work with you, the advisor, across the United States. We can run a case for you. And so the way to begin to recognize when you want to pull us in, you start to see a significant amount of equity building up in their home. That's when you think of us. We're home equity conversion specialists. And we can take a portion of that housing wealth and convert it into a very powerful tool and create liquidity where you didn't have any. And Don, with that, I want to thank you for your partnership, and for everybody across the Circle of Wealth family. Thank you for the work that you do. We look forward to partnering with you as the months and the years go along.
Thank you so much.